Imagine walking into a dealership and instead of negotiating up, they're practically begging you to take a brand new pickup truck off their lot. Sounds unreal, right? Well, that's exactly what's happening right now with GM's pickup trucks. Silverado 1500s, Sierra 1500s, and even heavy-duty models. Inventory has ballooned to the point where some lots are so overloaded, dealers don't have enough room to park all the unsold trucks. And the bigger question is, how did it get this bad? And what does it mean for the future of the truck market? First, let's break down why this is happening. GM has been pushing aggressive production even while demand has cooled down. Consumers, hit by high interest rates and tighter lending conditions, just aren't lining up for $70,000 to $90,000 trucks like they used to. At the same time, the shift towards EVs and hybrids is reshaping buying behavior. People are holding back, waiting to see where the industry goes, which leaves GM sitting on mountains of unsold gasoline-powered pickups. Now, when will dealers officially announce this to the market? Insiders suggest we're weeks away from seeing unprecedented incentives being rolled out, some as soon as the next quarter. Behind closed doors, dealers are preparing for massive discounts, trade-in bonuses, and even 0% financing just to move the metal. Public announcements will likely come in carefully worded press releases, but the reality is, those trucks are already being offered at near fire sale prices in certain regions. But what's the real reason behind this collapse in sales? It's not just about high prices, it's also about consumer fatigue. Buyers are fed up with pickup trucks being priced like luxury vehicles. 10 years ago, you could buy a brand new Silverado for under $30,000. Now, that same model has ballooned in price, pushing working-class buyers out of the market. Combine that with higher fuel costs and rising insurance premiums, and suddenly, the appeal of a massive full-size pickup isn't what it used to be. Other automakers are watching closely and reacting in very different ways. Ford, for example, has slowed down production of its F-150 in some plants to avoid the same inventory glut. Ram, meanwhile, is preparing to use GM's crisis as leverage, planning their own aggressive discounts to steal customers. Even Toyota and Nissan, who have smaller truck footprints in the US, are eyeing this as their moment to grab market share with more affordable offerings. Buyers, on the other hand, are split in their reactions. Some are excited, sensing that the long-awaited price collapse might finally be here, a chance to snag a truck for tens of thousands less than MSRP. But others are holding off, thinking, if prices are dropping now, what if they drop even further? That hesitation only worsens GM's problem, because waiting buyers mean even more trucks piling up unsold. The impact on dealerships is brutal. Many are drowning in floor plan financing costs, the interest they pay just to keep vehicles sitting on the lot. Some dealers are already slashing prices under the radar, eating into their margins just to clear space. If this continues, expect a wave of dealership consolidations or even closures, especially in smaller towns where trucks are the bread and butter of sales. And of course, the impact on prices across the board could be seismic. If GM trucks suddenly flood the market at massive discounts, it won't just hurt GM's profitability. It could trigger a domino effect. Used truck values would plummet, hurting current owners who suddenly find their trucks worth far less. Competing automakers would be forced to follow suit, leading to a full-blown price war in the truck segment. But here's the twist. Insiders warn this might not just be a temporary correction. It could be the start of a fundamental shift in the American truck market. For decades, these pickups have been the golden goose of automakers, delivering massive profit margins. If that model breaks, if consumers stop paying luxury prices for work trucks, the entire business strategy of Detroit automakers could come crashing down. And yet, this might just be the opportunity buyers have been waiting for. Imagine walking into a Chevy or GMC dealership and being offered discounts so deep, it feels like the dealer is paying you to drive away in a brand new truck. The question is, how far will GM go to fix this crisis? And what happens to the entire truck market when the biggest player starts a fire sale no one saw coming? Because here's where things get even more complicated. GM's entire EV strategy is tied to the success of its traditional trucks. The Silverado EV and Sierra EV were supposed to carry the brand into the future, riding on high demand from loyal truck buyers. But if the gas-powered lineup collapses in value, what does that say about the future of their electric counterparts? Why would a buyer spend $90,000 on an EV pickup when dealers are practically giving away gas versions for half the price? This threatens to undermine GM's carefully planned transition and could delay the company's EV rollout for years. Wall Street is already paying close attention. Investors who once saw GM's truck division as the cash cow are now questioning whether the golden era of sky-high truck profits is over. A collapse in truck sales doesn't just hurt quarterly earnings, it shakes confidence in the entire business model. If GM is forced into a massive discount war, margins will vanish, stock prices could tumble, and shareholders might demand drastic restructuring. Some analysts even speculate that GM might cut shifts at truck plants or mothball entire facilities if inventory levels don't improve. And then there's the possibility of government involvement. Remember, pickup trucks are deeply tied to US manufacturing jobs. A sudden collapse in demand could send shockwaves through the Midwest, threatening thousands of jobs at plants and suppliers. If things get bad enough, Washington may feel pressure to step in with incentives, subsidies, or even bailout-style measures to keep the industry afloat. After all, trucks aren't just vehicles, they're political symbols of American strength, and no administration wants to be the one presiding over their collapse. Meanwhile, behind the scenes, rival automakers are sharpening their knives. Ford is quietly adjusting production schedules, hoping to avoid GM's fate, while Ram is preparing to launch aggressive marketing campaigns targeting frustrated Chevy and GMC customers. Toyota and Nissan are considering temporary discounts of their own, but with smaller inventories, they have the luxury of waiting to see how deep GM digs itself before jumping in. The auto industry is playing a dangerous chess game, and GM might have just made the wrong move. For buyers, the psychological shift is already happening. Trucks, once seen as untouchable luxury symbols of status and power, are starting to look like overpriced liabilities. Social media is filled with videos of empty dealerships, unsold trucks gathering dust, and frustrated owners watching the value of their trucks collapse overnight. If this perception sticks, GM faces not just an inventory crisis, but a brand crisis, one that could take years to recover from. And this is where the ripple effects start to get really interesting. Because if the pickup truck bubble truly bursts, it won't just be GM dealers feeling the pain. It could send shockwaves through the entire US auto industry, reshaping how trucks are built, priced, and sold for decades to come. And if history has taught us anything, once consumer expectations reset, they rarely ever go back. If buyers get used to $20,000, $30,000 discounts on full-size pickups, there's no way they'll accept paying $70,000 again next year. This could permanently reset truck pricing across the industry, stripping automakers of the massive profit margins they've enjoyed for decades. The pickup truck, once the king of profitability, could become just another commodity vehicle, forcing GM, and everyone else, to rethink how they do business. This brings us to consumer loyalty. Truck buyers are famously brand loyal, often sticking with Chevy, GMC, or Ford for generations. But a crisis like this can shake that loyalty to its core. Imagine a Silverado owner who feels burned because their truck lost $15,000 in value in just 1 year. That frustration might push them straight into the arms of Ford, Ram, or even a foreign competitor. And if Toyota or Nissan plays their cards right by positioning themselves as the safe, stable choice, they could carve out a much bigger slice of the US truck market than anyone expected. Then comes the ripple effect on the used truck market. As brand new GM trucks are slashed in price, used models will tank in value almost instantly. That means thousands of current owners are suddenly underwater on their loans, owing more than their trucks are worth. This financial squeeze could lead to a surge in repossessions, damaged credit, and a flood of used inventory hitting auctions. Dealers who rely heavily on trade-ins will see their margins collapse because nobody wants to accept a truck that just lost a third of its value in 6 months. But here's the twist. This shakeup may also accelerate innovation. With profit margins drying up, automakers will have no choice but to rethink their strategies. Smaller, more affordable trucks could finally make a comeback, reversing decades of upsizing and price inflation. Companies may push harder into hybrids and fuel-efficient models to win back buyers, turned off by the cost of operating a massive V8. In a strange way, GM's crisis could kickstart a new era of practical, affordable trucks built for real working-class Americans. Still, the danger can't be ignored. If GM mishandles this situation, the collapse of its truck empire could become the single biggest automotive story of the decade. Dealers are already whispering about deep cuts to allocations, suppliers are bracing for fewer orders, and Wall Street is calculating how much of GM's bottom line is at risk. Everyone knows the storm is here. The only question is how long GM can survive it without taking the entire truck market down with them. And this sets the stage for the next big question. What happens if this crisis doesn't stop at GM? What if Ford, Ram, and even Toyota start to feel the same inventory pressure, leading to an all-out truck price war unlike anything America has seen before? Because if this spirals into a full-blown price war, the US truck market will never look the same again. Picture this. Ford, seeing GM slash prices, has no choice but to roll out its own aggressive discounts on the F-150, America's best-selling vehicle for decades. Ram, not wanting to be left behind, launches eye-popping rebates and bundles in free maintenance packages to lure away frustrated GM customers. Even Toyota, usually cautious about incentives, could be tempted to cut thousands off its Tundra just to capitalize on the chaos. Suddenly, the very brands that spent years driving truck prices higher are racing to see who can go lower, faster, and in that scenario, buyers hold all the power. Shoppers could start pitting dealerships against one another, playing Chevy, Ford, and Ram into bidding wars for their business. Imagine walking into a Ford lot, showing them a GM discount flyer, and walking out with a truck for $15,000 less than you expected. Or dealers throwing in thousands in accessories, bedliners, upgraded wheels, tech packages, just to get a sale. For consumers, it would feel like a golden age of truck buying, the kind of deals people haven't seen since the financial crash of 2008. But for the industry, this would be catastrophic. Automakers have built their financial foundations on trucks, relying on them to subsidize less profitable vehicles like compact cars and EVs. If those profits vanish in a race to the bottom, companies may be forced into brutal cost-cutting measures, shutting down plants, delaying EV projects, and slashing entire model lines. In other words, a price war might save buyers money today, but cost thousands of jobs tomorrow. Meanwhile, suppliers, the companies that build the parts, engines, and electronics for these trucks, would be squeezed the hardest. If GM, Ford, and Ram all start cutting orders to slow inventory growth, suppliers will be stuck with unsold parts and collapsing revenue. Smaller suppliers could face bankruptcy, creating ripple effects that disrupt the entire auto supply chain. And let's not forget Wall Street. Investors who once cheered record truck profits would be horrified by shrinking margins. Stocks for GM, Ford, and Stellantis could take massive hits, and credit rating agencies might start downgrading automakers. That, in turn, would make it even more expensive for these companies to borrow money to fund their EV transitions, digging the hole even deeper. But here's the most shocking part: an all-out price war might not even fix the problem. Because once consumers believe prices will keep falling, they'll hold off buying, waiting for an even better deal. That hesitation creates a vicious cycle. The more automakers cut prices, the more buyers wait, and the deeper the crisis grows. And yet, lurking under all of this chaos is the possibility of something even bigger. What if foreign automakers, especially the fast-rising Chinese brands, use this exact moment to storm the US market with ultra-cheap pickups? Because that's the nightmare scenario the Detroit automakers don't want to admit out loud. If GM cracks first, it could open the floodgates for foreign brands to walk right in and take over America's most profitable segment. Chinese automakers like BYD and Great Wall have already proven they can build capable pickups at a fraction of the cost. Imagine them stepping into the US market during GM's crisis, offering trucks with modern tech, hybrid powertrains, and sticker prices $20,000 lower than a Silverado or F-150. For price-shocked buyers, that could be impossible to ignore. And it's not just China. Automakers in South Korea, even startups from Europe, could see this as their chance to finally carve out a piece of the American truck market. For decades, the Big Three have enjoyed dominance in the US pickup segment, but a weakened GM creates a rare opening. If foreign trucks prove reliable and affordable, brand loyalty may not save Chevy or GMC. Instead, we could see a massive reshuffling of who Americans trust to build their workhorses. The timing couldn't be worse for GM either. The company is trying to convince the public to embrace its Ultium battery platform and its EV trucks. But if buyers are burned on resale values, discounts, and collapsing trust in the brand, will they really line up to gamble on GM's new technology? Or will they turn to Tesla, Rivian, or even a foreign EV maker that promises stability? The answer could decide whether GM survives this decade as a market leader or fades into irrelevance. Dealers, too, are caught in the middle. Some have already started whispering about diversifying their offerings, exploring whether they could one day sell foreign pickups alongside domestic ones if the demand is there. That idea would have been unthinkable just a few years ago, but in the face of shrinking profits, dealers may not stay loyal to Detroit forever. They'll sell whatever moves off the lot, and right now, GM trucks are piling up like unsold stock in a warehouse fire. Meanwhile, consumers are watching this drama unfold with a mix of frustration and anticipation. On one hand, longtime GM loyalists feel betrayed, watching their trucks lose value overnight. On the other, bargain hunters are circling like hawks, waiting for the exact moment when discounts peak and the deals become too good to pass up. Social media is amplifying both sides, with some buyers bragging about snagging unheard-of discounts, while others warn against touching a GM truck until the dust settles. But if there's one thing we know for certain, it's this. The collapse of GM's pickup dominance isn't just about one company. It's about the entire American truck market reaching a breaking point. High prices, bloated inventories, shifting consumer priorities, and foreign competition are all colliding at once. And when the dust clears, the US truck landscape may look completely unrecognizable. And yet, there's still one more layer to this crisis, one that almost nobody is talking about. What happens when the financial system, the banks, the lenders, the leasing companies, start to panic about trucks losing value faster than they can be financed? Because here's where things get truly dangerous, when the financial side of the truck market starts to unravel. Banks and lenders have been happily approving massive truck loans for years, often stretching them to 72 or even 84 months. Why? Because trucks held their value, and repossessions rarely left lenders in the red. But now, with GM trucks losing value faster than ever, that entire system is at risk of collapse. Imagine a Silverado owner who owes $65,000 on a truck that's suddenly worth $45,000 on the used market. The bank is trapped in a loan that's upside down, and if the buyer walks away, the lender eats a massive loss. Leasing companies are feeling the same shock. Their entire business model depends on predicting the future value of a vehicle at the end of a lease. But if trucks are suddenly worth tens of thousands less than forecasted, leasing firms will be slammed with losses when those trucks are returned. That means lease rates on new trucks will spike, credit will tighten, and buyers who relied on leasing to afford expensive pickups may be completely locked out of the market. This financial strain will trickle down to dealerships too. Floor plan financing, the credit lines dealers use to keep vehicles sitting on their lots, will get more expensive as banks reassess the risk of lending against unsold trucks. Dealers may face higher interest rates, stricter terms, or even reduced credit limits. And without financing, some smaller dealers won't be able to carry new inventory at all, accelerating a wave of dealership closures in rural America, where trucks make up the majority of sales. And here's where it could snowball into something much bigger. If lenders start pulling back across the board, not just on trucks, but on all auto loans, we could see a credit crunch ripple through the entire car market. Buyers would find it harder to qualify for financing, monthly payments would climb, and sales of everything from compact cars to SUVs would stall. What started as a GM truck crisis could metastasize into a nationwide auto industry meltdown. But let's zoom back out for a second, because beyond the financial chaos, this is also about culture. Pickup trucks aren't just vehicles. They're woven into the fabric of American identity. For decades, they've been symbols of strength, independence, and success. Now, with dealers practically giving them away, that image is being shattered. If trucks are no longer seen as aspirational, but instead as financial sinkholes, it could shift the cultural landscape in ways the automakers never expected. And the scary part? This might just be the beginning. The deeper we dig into GM's crisis, the clearer it becomes that we're not just looking at a temporary slowdown. We could be witnessing the unraveling of the very business model that built Detroit's dominance for nearly a century. The big question now is, what happens when GM is finally forced to make its move? Will they double down with record-shattering discounts to flood the market, or will they slash production, cut jobs, and try to starve their way back to balance? Inside GM headquarters, executives are already locked in heated debates over how to respond. On one side, there are the aggressive voices pushing for what they call a scorched earth strategy. Unleash the biggest discounts in history, flood the market, and accept short-term financial pain in exchange for clearing the lots. They argue that once those trucks are gone, GM can reset production and stabilize, even if it means sacrificing billions in profit this year. But on the other side are the cautious strategists, warning that such desperation could permanently destroy the brand's image. If GM becomes known as the automaker that always caves to discounts, buyers will never again pay full price for a Silverado or Sierra. Instead, they'll wait, knowing that another collapse is always around the corner. To these insiders, the better play is to quietly cut production, slow down the factories, and let inventory clear over time, even if it means plant shutdowns, layoffs, and political backlash in states that depend on GM jobs. And then there's the third, more radical camp, those who believe GM should use this crisis as a reset button. They argue it's time to reimagine the truck lineup completely. Smaller, more affordable pickups, hybrid options that appeal to cost-conscious buyers, and a pivot away from bloated $80,000 models that no longer resonate with the market. To them, this isn't just an inventory problem. It's a sign that the truck bubble has finally popped, and survival means adapting before Ford or Ram beat them to the punch. Meanwhile, dealers are caught in the crossfire. They want clarity. They want action. Many are pressuring GM to unleash deep discounts now because they're the ones paying the price to store thousands of unsold trucks. The longer GM hesitates, the more frustrated dealers become. Some are even quietly threatening to revolt, to stop ordering new stock until GM gives them the incentives needed to move what's already clogging their lots. And let's not forget the unions. Any talk of plant slowdowns or layoffs will bring the UAW straight into the spotlight. They'll demand guarantees that workers aren't sacrificed to fix GM's mistakes, and they may even push for strikes if they feel jobs are being put at risk. This adds yet another layer of pressure, because GM knows a labor battle on top of an inventory crisis could be disastrous. All the while, competitors are circling like sharks. Ford's marketing teams are already drafting ads that subtly, or not so subtly, highlight GM's weakness, painting the F-150 as the safe choice. Ram is strategizing new trims and packages to entice frustrated GM customers to jump ship. And Tesla, Rivian, and other EV disruptors are licking their chops, ready to say, why stick with the old guard when the future is already here? GM is cornered. They can't wait forever. Every day that passes, trucks pile higher, interest costs grow, and buyer confidence shrinks. The company is heading toward a defining moment, a choice between slashing prices, cutting production, or reinventing the truck itself. And if they make the wrong move, the fallout won't just sink GM's pickup division. It could spark a chain reaction that reshapes the entire US auto industry for decades. If GM chooses the scorched earth path, the truck market could be about to witness something we've never seen before. Think about it. Imagine walking into a dealership and instead of hearing about a few thousand off MSRP, you're staring at discounts in the tens of thousands. Silverado 1500s and Sierra 1500s that were once stickered at $70,000 could be advertised for $45,000, maybe even less if dealers are desperate enough. Heavy-duty models, the workhorses of farms and construction sites, could suddenly be priced like mid-level SUVs. It would be a once-in-a-lifetime clearance event that could shake the confidence of every other automaker still trying to hold the line on pricing, and the deals wouldn't stop at sticker prices. To keep financing from collapsing, GM could resurrect 0% loans for up to 72 months, a move we haven't seen since the 2008 financial crisis. They could add huge trade-in bonuses, giving thousands more for used trucks just to move new metal. Free maintenance packages, extended warranties, even fuel vouchers could be thrown in as sweeteners. GM knows if they go down this road, it has to feel like a feeding frenzy, a moment so irresistible that buyers who've been sitting on the sidelines have no choice but to dive in. But the risk of this strategy is monumental. Flooding the market with heavily discounted trucks doesn't just move inventory, it nukes the value of every Silverado and Sierra already on the road. Owners who bought in the last 2 or 3 years would see their trucks lose value almost overnight. And when loyal customers realize their $70,000 investment is suddenly worth $40,000 on trade-in, that loyalty could vanish in a heartbeat. GM risks alienating the very base that has kept their truck division alive for decades. Meanwhile, Ford and Ram would be forced to respond. If GM pulls the trigger on historic discounts, Ford can't afford to let the F-150 look overpriced in comparison. Ram would have to follow suit, cutting into their own margins just to keep customers from bolting. Suddenly, what started as GM's desperate move could spark a wildfire of discounts across the industry, dragging everyone into the mud. For buyers, that would mean deals stacking on top of deals, a truck market that looks more like a Black Friday sale than a stable business.